Thank you, everyone, for joining our Energy and Resources National webinar. It's the first one of these that RSM is hosting as a national webinar. We're going to basically be running through an hour of all things power and energy commodities. It's a big topic right now. Uranium. We're going to talk about lithium, a bit about energy transition and where we might be succeeding, failing, and a little bit on uranium, particularly around our policy setting and where that might sit in relation to the global ambition to achieve net zero. We have two panelists who will be doing most of the clever speaking today. We're very privileged to have them. The first panelist is Sam Berridge, portfolio manager with 15 years experience across mining and finance industry from Perennial Value Management. Sam is a scientist by education, so has a Bachelor of Applied Science, has worked as a geologist, and is now in the finance world. And if you haven't yet followed Sam on LinkedIn, I would highly recommend it because he has some fantastic content that he's putting out in relation to the science that sits behind energy transition and commodities. So give him a follow. He is also has a bit of a boxing background, and I will say Sam and I actually have had a sparring session in the past, and Sam went on to win a white collar boxing match. So well done on that one.
Geez, mate. Too kind.
Yeah, you're a fairly solid puncher. Talking about solid punches, we've also got Warren Pearce, who is the CEO of AMEC, Association Mining Exploration Companies. For those that don't know, AMEC is here to advocate for the mining industry in Australia and make it an attractive place for resource investment. I've been to a number of AMEC events, and RSM are privileged to be a sponsor of AMEC, and the work they do in the sector is it's well regarded. So thanks to you both for joining us this morning. We're going to keep it to an hour. We will have some questions coming in. I've got a few things planned as well. But to kick us off, Sam has offered to take us through some slides for the next 20-25 minutes, just giving us a bit of scene setting on where we're at with uranium, lithium, and energy transition generally. So go for it, Sam.
Thanks very much, Craig. I'll just share my screen here, and hopefully this comes through for everybody. If you wouldn't mind just shouting out if that's
all good.
That's all looking good.
Yep.
Yeah, so thanks very much for everybody for joining in. The brief that I was given is just to sort of touch, on the lithium and uranium outlooks and the various moving parts there to begin with, and then dive into this energy transition, which is a massive economic and investment thematic. And it's going to be with us for the next 20 or 30 years, I think, and it will evolve as time goes on. And I think being ahead of those changes within the energy transition is certainly going to be fertile ground for investment. But touching initially on the uranium price, after much euphoria in 2023, uranium hasn't done much over the course of 2024, and there has been a bit of head scratching around why, what's been holding the price back. I think the bull case for uranium is quite clear. I mean, I've got the headline headlines up there on the slide around big tech pivoting more and more so towards uranium as a means, and nuclear as a means of their clean energy solution. But the bigger question is, well, if that's the bull case, or that's what's driving demands, why, what's the bear case? What's been holding the price back? And I think if I had a gun to my head and had to come up with two reasons, the best that I can, or have been able to ascertain is, firstly, number one, the sense of urgency from utilities that was present towards the back half of 23 just seems to have relaxed a little bit through the first half of 24. I think that some of that utility buying has eased. They've realised that whilst inventories are running low at around 2 years for US utilities, they're not critical just yet. Albeit with a recent news over the weekend of Russia restricting enriched uranium, I think maybe that that level of relaxation is quickly evaporating, and perhaps we see some more buyer intensity coming in towards the back end of the calendar year. The other anecdote that's been shared that I've sort of come across, and I must admit this is, perhaps possibly does have a bit of a speculative element to it, but it feels as though it could well quite be correct, is that there was about £2 million of spare inventory which had been put aside for the commencement of another uranium ETF. But the process for getting that ETF up and running fell over, and so that uranium actually ended up making its way back out into market. And whilst £2 million doesn't seem like a huge amount in the context of the spot market, it can be it's up to 20%, or sorry, up to 10%, I should say, of volume traded. So it would have taken quite some time for that material to be soaked up, and it would have had a bit of a weight or a headwind for price. But my understanding is that's now being dealt. And so the uranium price has started to tick up over the last week and a half, and I think coupled with ongoing demand for clean energy power and uranium slowly but steadily establishing itself as the solution for carbon-free energy, I think the risks to demand are on the upside. But looking a bit further forward, and I think this is it's a fascinating comparison. As the world reacquaints itself with nuclear energy and nuclear tech in general, I think we will start to rediscover some of the massive advances that have been made in this space, prior to 1980, or prior to, the mid 1980s, when, Chernobyl happened and the world turned away from this technology. So, I mean, for instance, we've had windmills with us for, over 1,000 years. Today, average utilization in Australia for these wind turbines is about 34%. I know that is probably a little bit lower than the best in class offshore turbines, but I do have a preference for the hard data, and what's actually been achieved at the moment is 34% in Australia. In terms of solar, again, we've been using this, technology around the world for a very, very long time, and despite the rapid advances in efficiency and power capture in Australia at the moment, on average, the utilization for solar panels is only around about 15%. And the reason for that is captured in that little image on the slide in front of you. Is because the bulk of our solar panels are rooftop solar, and when they're installed at suboptimal angles. Often there's trees or other buildings around that create partial shade. So the utilization that you achieve is far less than what you would get for a commercial solar installation, which would be in a sort of flat paddock somewhere with no shade, and with all the panels set at the optimal angle, and you might get 25, 28% utilization out of that at best. So, that's where with all these advances in the two technologies where we are today, you compare that to the advances in nuclear tech, which have been achieved up to close to 50 years ago now. From splitting the atom in 1932 to the first radioisotope battery going on to the Voyager 1 satellite. I mean, that was 47 years ago that satellite was launched, and that battery is still at 30% charge. So this is absolutely outstanding technology compared to the life of lithium ion batteries today. In the mid 90s, we had the S9G small modular reactor. This is the one that sits in the back end of the Virginia class submarines, which Australia is trying to buy. Those submarines. So this reactor has one load of fuel which will last the lifetime of the sub. That is 33 years. Again, absolutely amazing technology. That nuclear reactor there will put out about 220 megawatts of power. So this tech that's been sitting, in the military sphere for a very long time, will eventually leak out into the civilian space, and I think has the potential to be, absolutely, world changing. And more recently, specifically on the battery front, there's been both US and Chinese companies working on nuclear or uranium coin batteries. The one in the image there purports to have a 100-year life. Only very small wattage or amperage out of this, but still, it gives a glimpse of the potential of the tech. And as I mentioned before, in an energy transition process, which is going to take 30 plus years, it's highly likely that the technology that we will be adopting at the end of that transition is likely to be quite different from the technology that we were adopting at the beginning of it. So switching back to lithium, because it still is the key component of EV batteries and battery storage solutions that are being installed around the world. I do think we are at the beginning of the end, I suppose, of this bear market, which has been running for about a year and a half now. Just over the last couple of months, we've had roughly 10% of global supply removed from the market. Some of that from Australian operations, but a big part of it is from the lepidolite production out of China. You can see on the chart on the bottom right that that bold red line there has shown that lepidolite production falling strongly. And actually, I got an updated chart just this morning on that, and we're now negative on a year-on-year basis. So, whilst the supply side is responding quite quickly, we still need the demand side to pick up for a meaningful price response and sustained pricing recovery. And on that point, I think if there's one headwind more than all the others, it is this pivot by the market towards hybrid vehicles rather than full electric vehicles. So these hybrids have been taking market share from the plug-in hybrids. The plug-in hybrids have been taking market share from the full battery electric vehicles, and they only need about 25% of the lithium per car, as opposed to the full electric EVs. And so, as a result, when you play around with your supply demand model, you have a look at the number of, either hybrid or battery EVs that's sold. When you start swapping those full EVs to hybrids, then you need 4 times as many sales to get the same amount of lithium demand. So that's the headwind for it. And that'll move around depending on the new models of vehicle that come out and consumer preferences. But back to the shorter term, lithium carbonate inventories, chart on the left there, are starting to come down. The market is starting to rebalance. And so, to my point, I think we are, towards the beginning of the end of this bear market, and bluer skies are, should be with us in 2025. So that's a sort of my views of lithium and uranium in a nutshell. But both of those feed into the energy transition, which which is near and dear to my heart, and it should be near and dear to everybody's heart, because the implications on quality of life, standard of living, interest rates, and just general Australian GDP cannot be overstated. And in the flow through from the energy transition into each of one of those thematics. And I must admit, I think we are on the wrong path. And the reason why I say that with high conviction is because the precedent for the path that we are on is so very, very clear. Whether you look at Germany, whether you look at the UK, whether you look at New Zealand, all of them have run into severe economic headwinds as a direct result of the decarbonisation policy that they are pursuing and that Australia is copying. So first and foremost, our emissions aren't really falling that fast, despite the amount of money that we're spending on it. The Australian emissions have near off flatlined from about 2021, just after the COVID recovery. And that's despite installing roughly 16 gigawatts of wind and solar across the country. So the huge amount of money is being spent. Retail power prices are up circa 30% over that period, and we are starting to get business closures due to high power prices. So, for example, a few that have made the headlines here, Qenos, which was a big plastics manufacturer, which had factories in both Victoria and New South Wales in Botany Bay. They closed down earlier this year as a result of high power and specifically gas prices. And when these big, heavy industrial companies or factories start closing down, it causes ripple effects through the through heavy industry. So, as an example, because Qenos shut down, there was another chemicals manufacturer called Indorama, which was sourcing its polyethylene from Qenos. That was Qenos was their sole supplier. So once Qenos shut down, then Indorama shut down as well because they were no longer viable. And now Australia is going to have to import the products that these companies both used to manufacture here. They're going to have to import them from overseas, which probably results in higher emissions than what these companies would have been producing in the first place. But to bring things a bit closer to home, and there's been lots of there were more ripples in the press on this issue just over the weekend. But the food manufacturing industry is again really struggling with high gas and high power prices. And I know manufacturing doesn't get a huge amount of press in Australia, but it is a massive employer. So roughly 914,000 people, or just under 10% of Australian jobs, sit within the manufacturing sector. And all of that sector is highly sensitive to energy and specifically gas prices. And the food manufacturers, a little while ago, it was Mars Foods, and then over the weekend, the CEO of I think it was Cadbury Foods are warning that they are close to shutting down their operations and moving that food manufacturing overseas because it is struggling to be viable in Australia. And again, if these industries were start to shut down, then we will have those cascading negative feedback loop of further job losses as the suppliers to those industries also shut down. But again, this shouldn't be new news to us because the precedent for it is clear. So we look back to what happened in Germany. Their high power costs, high gas prices, have been detrimental to their energy-intensive industry. You can see that the strong divergence of their energy-intensive industry from their just general industrial production. Just last month, we had a German stalwart company, Volkswagen, announced that it was looking at shutting plants and looking at laying off thousands of staff because they just are no longer competitive globally with German power prices. This has been an absolute devastating impact for the German economy, so much so that it's actually resulted in the collapse of the government, and new elections were called last week, I think, and they're just the government's scrambling to arrange them. But as bad as things have been for Germany, they would have been a hell of a lot worse if they couldn't rely on France and rely on Scandinavia to import power when they need it. If you're an island nation like New Zealand, you can't import your power from anywhere. So if you're not aware of what happened back in August, New Zealand basically ran out of, or was going to run out of electricity. And this is a function of a decision taken back in 2018 to basically ban oil and gas exploration. And I note that one of the Teals has put forward a similar proposition to Parliament just recently to ban seismic surveys offshore, which is critical for replacing oil and gas supply. But anyway, the precedent here in New Zealand, they did exactly that. And over time, gas fields deplete, and New Zealand gas production fell by 40% over the subsequent 6 years from putting the ban in place. And that didn't matter until it didn't rain. So New Zealand gets about 60% of its power from hydro. They had a dry winter. Normally that wouldn't matter because you just lean on gas for a little while until it rained. But the gas ran out. And so the New Zealand gas price rose from circa $10 a gigajoule up to $30 a gigajoule towards into the end of July and August. And that was on. So as the background to that included The largest gas manufacturer, which was a company called Methanex, they shut down their production and delivered and sold their gas into the grid so that the lights would stay on. But then the suppliers to Methanex were also shut down. So you had that same cascading negative feedback loop of job losses throughout the New Zealand economy. This is going to be very difficult to come back from because, even though the ban on oil and gas exploration has been reversed by the new government there, companies and investors alike, and I put myself in this basket, would be very reluctant to return and put money into New Zealand to sponsor an industry which might, you might have a change of government and then backflip again and you've done your dough. So, there are strong parallels with what's happened there with what we're doing in Australia. And I think Australia is about 18 months behind. I mean, this is our domestic gas price here. It is starting to tick up as domestic gas balances tighten. One of the key fields in East Coast Australia is the Bass Strait, which runs through the Longford gas plant. That is down 30% from its peak, and the outlook is for quite a steep decline over the next few years. This decline is much faster, than what demand is dropping. And again, we've seen the precedent for this. At some point, that gas will go close to running out, and you will have cascading job losses through the economy when that happens. Not to mention higher inflation, and that of course keeps interest rates higher than what they otherwise might have been. But if this is sort of some of the negatives that are viewed through the lens of gas primarily, because this is a key part of the firming solution for wind and solar. Let's just have a look at the perhaps look at the upside. Like, we hear these terms of green energy superpower, but again, I can't see where that cash is going to come from. Like, usually if a country becomes a superpower in something, there is an economic dividend for the population of that company. Yet when it comes to wind and solar and batteries and renewable heavy transition, I can't see the evidence or the dividend to citizens of that country flowing through. So if we take Adelaide South Australia as an example, 75% of their power comes from wind and solar. They do frequently have an excess of wind and solar power, but despite that, they're a net energy importer from Victoria. So from about 2021, Victoria has been a net exporter to South Australia. This has been a reversal of the status quo from the prior 4 years to that. This is consistent with what happened in Germany. They were a net exporter of power until they shut down their nuclear industry. They are now a net importer of power. But what makes things worse for South Australia is the fact that when they export power, it's at a loss. So you can jump on to openenergy.org, and for most weeks that I've seen, and certainly the rolling year average for the energy exports, it's often at a negative price. And this is because when there is excess wind and solar power in South Australia, it's also sunny and windy in New South Wales and Victoria, so they don't need the power, and therefore, exporting it is a loss-making exercise. And so then this calls into question some of these transmission lines which are being built all over the place, and it speaks to some of the claims made by the Centre of Independent Studies and other groups which look at this very closely, is that there seems to be an absence of any net benefit to consumers for these billions of dollars of infrastructure that's being built all over the East Coast and slowly making its way to the West Coast as well. If you keep on doing this, you make tens of billions of dollars of investment with a negative return for the people that fund it, the taxpayers. Well, this will make the country poorer and impact quality of life, and ultimately also push up power prices as well. But just having a little bit of a look at the granularity of how these power prices are pushing up, it's very specific to what consumers pay. So Wholesale power prices, do move around a fair bit. It's fair to say they have been coming down recently from their peak in 2021, but retail customers, so you and I, we haven't experienced or enjoyed any of that drop in power prices, and that's because all the other components of the bill stack, which then feed into the retail power price, they're becoming higher and higher. And you can see the divergence, just taking South Australia as an example, from the wholesale power price compared to the retail power price, which now is up around 45 to 50 cents per kilowatt hour in South Australia. And the way that's made up is you have the wholesale power price, which is what the wind and solar people produce. But then on top of that, you've got transmission, distribution is the big one, environmental benefits as well, and then obviously a retail margin on top of that. And it's this component of the bill stack where a huge amount of cost is coming into the power system, which is to sort of fund or pay for the conversion of an intermittent product into a 24/7 service. That is the expensive part. It's fair to say that if you need to produce a kilowatt of or a megawatt of power at any given time point of day, if the sun is shining or the wind is blowing, then yes, wind and solar can do that quite cheaply. But to convert that into a 24/7 service, which industry can rely on, is hugely expensive, and it is the largest part of the bill stack now that people are getting at their homes. Now, I'll drill down into this chart just a little bit further, particularly into the probably environmental / distribution side of it, and that is the amount of financial support which is required to allow these wind and solar projects to achieve a satisfactory return. And I'm talking about specifically the Large Generation Certificate, or LGC for short. This was a scheme introduced as part of the Renewable Energy Target many years ago now. The reason this scheme was introduced was to spur a big bounce in wind and solar investment, and it was very successful in that regard. And the reason why it was so successful was that it almost doubled the revenues from wind and solar projects because they could sell their power twice effectively. You'd sell it once, as in the electrons that go down the wire, but then you could sell an LGC certificate for every megawatt hour you produced, and that was a huge boost to revenue. So I've taken a snapshot here from a company called Infigen. These guys got taken over in 2020. But in their last set of financial results, you can see out of 235 million of revenue, 41% of that, or almost 42%, came from these LGC certificates. Now, these costs are ultimately recouped from the consumer, so they end up making retail power prices more expensive. Infigen was taken over by another company called Iberdrola Group. My back of the envelope calculation is that in the 4 years or 3 years subsequent to buying the Infigen assets, they did expand them. I think their LGC revenue was roughly 118 million in 2023, and they paid zero tax on that. So you have this you have these claims of Australia becoming a renewable energy superpower. I see this as an example of socializing the costs of green or wind and solar energy and privatizing the gains. So these companies have still made profits which will go to their shareholders, but so much of the costs sit with the energy consumer and retail customers in Australia. And I really don't think there's much of a future in that. And certainly the precedents from Germany, from the UK, from New Zealand, the examples are that the examples from countries which are 18 months to 2 years to 3 years ahead of us down this journey are not great. So I think with that, I might turn back over to Craig to host the Q&A. Thank you very much.
Sam, thank you very much. I think I'm I'm pretty passionate about energy transition as well, and I think everybody on this call and listening would agree with the ideology of net zero and the ambition. But I think it's the opportunity to shed light on the engineering and the science that it's going to take to get us there. That is so critical. I'll allow Q&A to start coming in. So if there's questions, please start feeding them through. But Warren, I might just start with you. Sam made the comment about an Australian ambition of being a superpower in in green energy or decarbonizing the world. Um, just a couple of things on that. If you look at carbon intensity, nuclear, University of Texas here has it at around 12 grams CO2 per equivalent kilowatt hour. If you look at wind, you're at 14 grams. You look at solar, you're sort of 20 to 50. So it is our lowest carbon intensive source. I was reading something over the course of the last week from the World Economic Forum talking about global net zero by 2050, and in essence concluding that without there being a sufficient nuclear generation capacity in the global energy mix, um, net zero by mid-century is almost impossible. We've got the US, France, Canada, UK, Germany, Japan, South Korea with nuclear generation. We've got China and India building. I guess I liken it a bit to how Australian iron ore really helped industrialize China. And when I wind that off and I'm thinking about uranium, we hold 33% of the world's proven uranium deposits here in Australia. Um, which we have a ban on, and it's not one of our critical minerals. It just strikes me as something that doesn't make a heap of sense, Warren. And I know AMIC's been doing a lot of work in this, so I might just hand over to you on that.
Yeah, thanks, Craig. Look, I think when you look towards the 2050 net zero target, how are we actually traveling towards it? The answer, I think, is not well. There are a few reasons for that. You bring that back to the absolute upstream end of that, and whether we'll be able to provide the critical minerals or the minerals required for that energy transition to take place in the time frame we have, looks a little questionable. Particularly key commodities like copper and nickel. The reality is we would have to increase those supply something like 2 to 3 times in that period. And at the moment, the resources of those commodities simply aren't available. More exploration and more discovery will have to take place of commercially viable projects in order to get that into the market in the timely way. The problem is the only way that is going to happen is if the market is able to provide the necessary incentives for that exploration to be done, for those projects to be turned on. That means the prices need to rise. None of which points to a particularly cost-effective energy transition. So ultimately, when I look at 2050, what I talk about is it's absolutely everything. If we're going to get to net zero by 2050, absolutely everything, including uranium and nuclear, including carbon capture, including pretty much every renewable technology and its wide-scale implementation, along with the various transition commodities in the energy market, such as gas, are going to have to happen, and they're all going to have to happen pretty much perfectly over the next 25 years for us to get there. That's not something you'd want to bet your house on. So we're working with a pretty big catch up in order for this to occur. That said, there is an energy transition taking place. The question is, are we doing that in the right way? I think for my industry, the critical minerals piece, I certainly see in any form, there's going to be a much greater pickup of renewable technologies, particularly wind and solar, in that space, and a wide-scale implementation of that. What ultimate part of the mix that makes up, I don't know, but it's certainly going to be much bigger than it is. And if you're in my end of the industry, the upstream, trying to provide minerals into those markets, that's usually a pretty good place to be. Where the demand looks like it's going to grow quite substantially over a period of decades, there's a good space for us to be in. We're not necessarily seeing the price signals we want right now, particularly in lithium and nickel. We're getting an absolute pasting here in Australia in those two industries right now. In lithium, an emerging market story. The truth is, it's volatile. It's going to go up and down. Those ups and downs tend not to last as long as people forecast. Interested to read sort of Sam's take on where we are in terms of the bear market of that. I think he's probably right. I think we're going to come back out of those low price environment relatively soon. What that means for whether those mines that have gone into care and maintenance can restart, I think that might take a little longer, but I'm not as negative about that position as perhaps some people are. The uranium space, I think Australia's going to have to come to terms with a difficult political issue and a difficult community issue in order for us to succeed here. There is a place for uranium and nuclear in Australia. We have good resources. If you simply look at the uranium piece, well, the reality is a large portion of our partner nations, 19 of the 20 G20 nations, are pursuing nuclear as part of their strategy to decarbonise. They need uranium to do that. Australia has good uranium resources. We're a reliable supplier. We can do that in a cost-effective way. We should be investing in this space, if only to help other nations decarbonise as part of the net zero journey. Beyond that, we should be thinking about what that means for Australia and whether nuclear fits part of our story. I'm encouraged to see the fact that Peter Dutton and the coalition has put nuclear on the radar here in Australia, and it's not been hit for six initially. People seem willing to look at this as a pathway to net zero while they start to understand the challenges that come with wide-scale implementation of renewable technologies, what the implications are for land users and large tracts of the environment that need to be used for these spaces, and the fact that it's not going quite as well as we thought or we hoped, and indeed our costs are not going down. So in that space, that starts to bring people back to looking at other options. We're interested to see how that develops over the next sort of 6 months in the lead up to the federal election. But there probably is a role for nuclear here in Australia. We've clearly accepted the idea that it's safe with nuclear submarines. We're getting past some of those long-held concerns. Let's start talking about whether it makes sense, whether it's cost-effective, how it works in terms of an energy mix. We've got to get smarter. For me, it's all about saying, if you're serious about net zero 2050, it's all of the above. Absolutely everything has to be tried, implemented and used to make up that change. We're just having to make such a major change in our energy transformation in such a short period. Unless absolutely everything goes perfectly, we're not going to get there. So we've got to try everything.
Absolutely, Warren. I think Sam, maybe just flicking back to you. I think one of the big reasons against nuclear, or one of the points raised, is the capital cost and the lead time to bring nuclear generation into Australia. But bring that back to transmission and the grid and where we're sitting with high voltage. I was having a look this week. So the CSIRO has put out, we'll need 10,000 kilometers of new high voltage transmission by 2050. 10,000 kilometers of new high voltage to support what we're trying to, in essence, do. And then the CBA put out something by one of their senior economists, essentially saying that transmission could cost, in the order of sort of 3 trillion Australian dollars, over 100 billion a year, to build out that. I think so, Sam. I think it strikes me as 10,000 kilometers of new high voltage. I think if I look at that and I look at our capacity to build that and achieve that, it does seem an extremely steep challenge. I think, and I remember even myself in another life, driving down a 10-15 kilometer stretch of road near Mildura, seeing somewhere in the region of 600 to 700 megawatts of solar power generation stalled because it couldn't connect to a grid. What's your view on this? I mean, I think if you look on the ASX, some of the companies exposed to high voltage construction in the future have had some really strong tailwind supporting them, but building out 10,000 kilometers of new high voltage transmission is going to have a whole range of challenges with that. What's your thoughts on that, Sam?
I just think it's not going to happen in the time that we've given for it to take place. I mean, as Warren said, and I think he's exactly right, we need an all of the above strategy if you're serious about achieving net zero by 2050. And even if it does take a long time for nuclear to be built out as part of the solution, that's what we need to do. Australia, a lot of the pushback from nuclear is that it's not going to be ready in time to meet our 2030 or our 2040, 2035 emission targets. Well, I mean, what are the temperature ramifications if we don't meet that target? I mean, in aggregate, Australian emissions are almost irrelevant, but we need to do our part, and that's fair enough. But nobody signed up for economic martyrdom to achieve these goals. The promise that was made is that our costs were actually going to be lower under a renewable grid. That's what the CSIRO has tried to tell us for the best part of it, or half a decade now. And the reality is it's turned out to be incorrect. And if it's incorrect and it turns out power prices are much higher, then the electorate is going to reject that, and we're going to go back to the status quo, which is largely leaning on coal. And you've seen, time and time again, as these, some of these larger power stations, or the ones that are remaining, are due to be shut down. They're subsidised to stay into the grid, because if they weren't there, then there'd be blackouts, and and that's just completely unacceptable. So. Yeah, I mean, it seems as though the energy transition in this country, and many others, I'd add, have been goal-seeked to the profitability of the wind and solar industry, rather than goal-seeked to a economically viable and acceptable path to lower emissions, which is all of the above type strategy.
Absolutely, and I think just turning us back to nuclear power, there's a question that's come in here that's talked about small modular reactors. Sam, did some research just over the course of the week about the grid and the interface that nuclear might be able to have on it, and in particular whether there could be some viability to backfilling our existing coal-fired power infrastructure with potentially smaller modular reactors, because you're in a closer proximity to where the energy generation demand is. The grid infrastructure is generally better. You might not need as much new transmission. Small modular reactors, it's talked about quite a lot. How do you see that? Would that be something viable? And would location in proximity to redundant coal-fired infrastructure be viable?
I think that the small modular reactors is probably a further bridge to cross, or a longer dated bridge to cross than the established larger reactors which are already being built around the world. The power industry in general enjoys and responds very well to economies of scale. So you don't have I don't know, a couple of dozen V6 engines, producing electricity. You just have one whopping great big, gas turbine, because the economics and the unit costs that scale that come with scale are so much better, and that applies to nuclear generation as well. So, if we're in a hurry, we want the lowest cost solution right now, then we would adopt AP1000 or another model of an existing technology and start rolling it out. Exactly like Dubai did. 15 years ago or thereabouts. I think that is the safest, lowest risk and cheapest path forward. And then perhaps in the next decade or so, then there will be some rapid advances in these smaller modular reactors. You might be able to save a huge amount of money on the civil costs, which are a large component of reactor capex, is preferring the civils. And if you can avoid that or minimize that via a smaller modular solution, then perhaps they start to displace the incumbent large reactor tech. But there is a long way to go down that path. Perhaps more probably first and foremost, maybe for mining or remote power generation requirements, but for bulk decarbonisation, The precedent is, you follow Ontario or you follow the United Arab Emirates, or even when the construction costs and timelines of these larger reactors blow out, like they did in Georgia in the United States, like they did in Finland as well, is that the cost to consumer, even after that big capex blowout, is still a half to a third of what we pay here in Australia. That is the number that counts. I mean, I know people get scared by the capex figures up front, but what is nearest and dearest to consumers' hearts is what appears on their power bill. And as an example, in Georgia, where the Vogel reactor ran 10 billion over budget and took an extra, I think, 10 years or 12 years to build, their cost of power is 16 US cents per kilowatt hour, or at the retail level. So something that Australian consumers and business would find very, very appealing, I think.
Absolutely. Yeah, it's
Craig, just on SMRs, I mean, look, the technology is still in development, but I mean, I think longer term, the number of people in the mining industry look quite favourably towards them, particularly on remote power solutions. But it relies on a couple of things happening. One, the technology developing to a level, but also it relies on people becoming more comfortable with the idea of these things being out there, and it would need Australia to develop a strong regulatory framework in preparation for that happening. None of those things right now are happening at the speed they need to. But that's a space that certainly you can imagine right now. We've got a lot of large-scale projects in remote areas, not connected to grids, so can't access the benefits of the renewables being plugged in. They have to build their own generation plants or introduce solar and wind and batteries to try and find a way of mixing and providing that decarbonised picture. So it's a different pathway to it, but we'll have to wait and see how the technology develops.
Warren, just on back on lithium, Sam mentioned in his presentation that maybe that we're getting close to the end of the bear market in lithium at the moment. A little bit that I've seen some research, long-term demand for lithium for EV purposes is still there. It looks to be there, yeah. So what's your thoughts on that, Warren? I mean,
yeah, so I think you just got to try to understand around what happens with emerging industries is, although the demand looks really like this straight line that just goes north, they don't grow in a linear fashion. What happens is they grow in spurts and you go through a volatility. So the line's always heading up, but you have ups and downs and they're quite severe, particularly in markets that aren't transparent, where there's been a low amount of commodity being moved generally, which means comparatively small amounts can impact the market quite heavily. So we've been through two of these now in 3 years. I remember watching 5-member companies put their minds into care and maintenance 4 years ago because they all brought on, there was a huge supply production glut, and the various parts of the supply chain they were selling into hadn't been able to grow as quickly and consequently couldn't take the product. Within the last 18 months ago, if you're in lithium, you'd never seen prices so good. There was a supply shortage, the supply chain had started to grow, there was huge demand arriving very quickly, suddenly the price rocketed through the roof. 6 months ago, 12 months ago, we watched that start to fall again, and now we're in a period where very difficult to produce the product at the price we can sell it for. It'll pick up again. The long-term demand hasn't really changed. What has changed is the speed of growth. So the fact we've still got growth in the market, but what is happening is particularly the pickup of EVs has started to slow. As that slowed, the demand for the product's fallen. We'll continue to see growth in that space. I don't think anyone's concerned about the longer term, the medium or longer term picture. The challenge is being able to survive the lows to take advantage of the highs and making sure the industry we establish here in Australia is able to survive those challenging periods. So we're there as an established picture going forward. And ultimately over time, those emerging industries become established markets. You get a more transparent picture. It's a much more understood arrangement, and consequently the highs and lows aren't so severe, and consequently it's much easier for companies to manage through those periods. So I'm not negative about it. It's a difficult period at the moment. This is a space that, to be honest, some government support through those temporary difficult periods would be valuable, but we've got to hold on to our place. whether you think the energy transition is going well, the reality is it's happening. The renewable technologies and the supply chain into that pathway with EVs and renewable technologies is one of the fastest growing and largest industries in the world, and we need to hold on to a piece of it. We're on the ground floor because we already produce a range of the minerals that go into those supply chains. If we can get a bigger piece and hold on to it as that industry and that whole supply chain grows, we'll be able to grow a piece of it as well. And that's ultimately very beneficial for Australia. We just need to understand it's not always going to be sunshine. We're going to go through the highs and lows on the journey. But ultimately, if we can hold on to a substantial foundation piece, it's going to set us up very well for the future.
That strike me, Warren, that you know, like uranium, Australia has a significant role to play in the global supply side like that. I had a look this week at, you know, it's still suggesting we're 250 to 300,000 tons undersupplied at a global level. If I think of the 60s and the 70s, when in iron ore, Warren, we had the government very favourable towards the emerging iron ore industry with state agreements and concessions on building out this infrastructure with port, rail, and a whole heap of other things. It feels to me since those and that built the titan of an industry that we have now in iron ore. It doesn't feel like we're seeing that same type of arrangement or support for the lithium industry. I mean, is there a role for something like state agreements to be coming back in supporting the lithium industry on fast tracking development with some of these projects?
There's a lot of roles that government can play. I think there always a role for that. I think our governments have got to get much better about wanting and being prepared to do what it takes to attract investment. What our previous successes have meant, we've become a little less concerned about it coming our way. We've seen investment keep coming into Australian mining for a long period of time, and that seemed to snowball into others. We haven't had to work too hard for it. The fact that we've been a stable and relatively low risk jurisdiction has been enough to keep that coming, along with such substantial geological prospectivity. So that's great, but what we're realising now is the rest of the world is starting to compete very hard for that investment. And ultimately, once your investment goes into the ground, it's not going anywhere else. If you can get that investment into Australia, then ultimately the operations that are set up aren't likely to move unless something quite significant happens globally. So you've got to get that money, that investment in the first place, and you've got to be prepared to do what it takes. And we think about the investments we made in iron ore, the investments we made in LNG here in Western Australia with the Northwest Shelf and the Dampier-Bunbury pipeline. We're prepared to think differently to get the investment to set ourselves up long term. We sort of stopped thinking like that. We've got to start thinking, okay, how do we make it more attractive for investors to throw their money in? How do they able to return some of the capital they've sunk in earlier? We're talking projects that are going to last decades, that will return benefits to the state and the nation long term. But I think the reality is we're simply not prepared to think in the way that other countries start to think about it, which is not just about, and that's the bit about it, it's not just about this wanting to be part of the energy transition, or even countries wanting to remove some vulnerability from their supply chains. It's actually about the value. Countries are throwing money at this stuff to get that investment because they know if they can get a piece of one of the most high value industries in the world, they're going to do very well from it. And we've got to be smart about it. We've got to try and track that investment, particularly for two reasons. One is it'll set us up really well, but equally, if investment doesn't come to Australia, it's going to go to our competitors, and that can have really big impacts on our existing industries. Just look at the nickel industry.
Thank you, Warren. Sam, I don't think we can talk about energy and energy transition without just touching on gas. Just with what Warren was saying, I think some of the clever things we did in iron ore in the 60s and 70s to create that industry also translated to what we did on the Northwest Shelf, where we have some level of domestic gas security in Western Australia. It strikes me as crazy to think we've got gas import terminals on the East Coast and looking at bringing in gas. The role that gas plays in energy transition seems to be very, very misunderstood. Sam, um, what are your thoughts on that?
It's almost like there's a schizophrenic sort of attitude towards gas across, federal and state governments. We have AEMO and everybody else who has any semblance of energy literacy saying that gas is absolutely critical to the energy transition in Australia. And that's a quote from Daniel Westerman, I think is the CEO of AEMO. So nobody with any credibility disagrees with that. And yet we're through punitive government regulation, and there's various NGOs out there that are lobbying against any gas development that it pops its head up. Interestingly, though, except for gas imports, and I'll get to that in a second, it raises the cost of capital, and it speaks to a lot of the points that Warren made. Is that the returns that these companies need and the gas prices that they need to justify the additional cost burden that some of these new regulations impose upon these projects just means that power or energy is going to be much more expensive. Gas does, to a large extent, determine what the power price is, because it is the marginal megawatt hour that comes into the grid is via those gas peakers. And in a country like, a state like Colorado, which has got a similar wind solar mix to Australia in aggregate, their power costs are circa 16.70 cents a kilowatt hour. And the reason why they're so much lower, despite them having the same wind and solar, is because their price of gas is circa $3 a gigajoule, whereas in Australia we're looking at sort of $11, $12 a gigajoule, about to go to $17 a gigajoule when LNG imports commence in 2026. And I say that with a reasonable level of certainty because, again, anybody that operates within energy markets on the east coast of Australia, will agree that LNG imports are now inevitable. The decline of gas production in southeastern Australia, so Victoria, New South Wales, is now past a point of no return. The only way to replace that in the time that we've got is via LNG imports. And my understanding is that there's been a bit of a ring around by government to the major utilities to put their heads together and work out how much LNG gas that they can take, because the initial cargoes of imports will be loss-making. The terminal that's already been built is Andrew Forrest's Squadron Energy, out there at Port Kembla in New South Wales. The government does not want to underwrite the initial cargoes through that terminal because giving blank checks to billionaires is always a bad look. And so the government's told the utilities, you put your heads together, work out how much gas you need to take, you wear the cost of that, and we'll allow you to pass that through to consumers, so you don't end up taking a loss on it. But this is the conversation that's being had at present, and it'll take a while to work through. But again, the outcome of that is higher cost, higher emission gas than what would have been possible if we had have just allowed the industry to continue without punitive regulation through the east coast of Australia. So it really is a lose-lose situation. But unfortunately now the die is cast. But just hopefully in Western Australia we can learn from that and avoid the same mistake.
Yeah, thank you, Sam. We're almost on the hour, so I'm going to wrap up. I think we can safely say, energy security, and therefore, our position on uranium, gas, lithium, the infrastructure that's required with the grid, that is something that, as you said, Sam's dear to your heart, dear to mine. I think it is something that we need a lot more exposure of the science and the engineering and the technicalities of this, because I think if you look at what's happened in the Ukraine, it's just an example of energy security, and the dire effects that have come from that. We don't need that. We've got such an abundant resource of energy here. It just feels like we really should get it right. Thank you very much for both of you for participating. Thank you to everyone who's been online. We'll be circulating this to get some more uptake from it. Appreciate the hour, and look out for a few more of these in 2025 as we look to bring more on energy and resources to our client base. Thanks again, Warren. Thanks again, Sam. And that's us for today.
Pleasure. Thanks very much, Craig.
Cheers, Craig. Cheers, Sam.